Imagine for a moment that you needed to borrow $1,000 tomorrow. You do not have great credit. You do not want to fill out a stack of paperwork. You do not want to pay interest to a faceless institution. And you would like the money in your hands within days. In most of the world, in 2026, that request runs into a wall. The bank says no. The credit card charges 20%. The payday lender takes a piece of your soul. But across 6 Asian cultures, separated by thousands of miles and overlapping centuries of history, ordinary families have been quietly solving exactly this problem for hundreds of years. Real money in real amounts, fast, with no paperwork, no banks, and very low default rates. The system that lets them do this has 6 different names. The Chinese call it hui, the Koreans call it gye, sometimes romanized kie. The Japanese call it tanomoshiko or mujin. The Filipinos call it paluwagan. The Vietnamese call it hui or ho. And across India, Pakistan, and Bangladesh, South Asians call it a chit fund or committee. These systems are not entirely independent inventions. Rotating credit associations of this type exist across the entire world. Tandas in Mexico, Susus in West Africa, Stokvels in South Africa, EQB in Ethiopia, Gamea in Egypt. Wherever you find communities that trusted each other and were poorly served by formal banks, you find some version of this idea. What's special about the 6 Asian versions is how deeply they were developed, how long they ran, and how dramatically they shaped immigrant economies in the modern world. By the end of this video, you are going to understand exactly how each version works, why so many cultures converged on the same structure, what made these systems survive into the modern world, and what you can actually take from them, whether you are Asian or not. Because this is one of those rare cases where an older technology is still beating the newer one, in 2026, in plain sight. Before we start, if you are new here, this channel digs into how Asian communities built fortunes the mainstream world rarely talks about. Hit subscribe so you do not miss the next one. It helps the channel more than you would think. Let's start with the Chinese version, called hui. It is one of the oldest documented forms of this system, with roots going back roughly 2,000 years. A hui works like this. 10 people who know each other agree to contribute $100 each every month for 10 months. Each month, the entire $1,000 pot goes to one of the members. The order is decided by drawing lots, by bidding, or by need. If you take the pot in month 1, you have received $1,000 and only paid in $100. That is effectively a $900 loan with no formal interest. If you take the pot in month 10, you have paid in $900 over the months and finally received the $1,000. In the simplest version, you have broken even. Everyone in the middle gets some mix of both. Critically, the people who took the money first have to keep paying their $100 every month for the remaining months, even though they have already received the pot. That continued obligation is what makes the whole thing work. In the bidding variant, called biao hui, members compete for early access to the pot. The winner accepts a discount, and that discount becomes effective interest paid to the later members. So later participants in a biao hui actually do earn a return. They just earn it from their peers instead of from a bank. The genius of the hui is that one structure simultaneously functions as a loan, a forced savings plan, and an insurance policy against future cash crunches. There is no interest paid to any institution. The whole value cycles inside the group. And because the members know each other, default rates are low. The hui does have someone in charge. The organizer, called the hui tao, manages contributions, settles disputes, and bears reputational risk if the group collapses. So these systems are not literally banking without bankers. They have informal bankers. What they don't have is buildings, shareholders, salaries, or advertising. Now look at the Korean version gye. Mechanically, it's almost identical to a hui. A group pools money each month, takes turns receiving the pot, and continues contributing until everyone has had their turn. What's different is the culture around it. The Korean jai is deeply social. It's not just a credit tool, it's an entire social institution. A jai might run for years, even decades. The members meet for dinners. Children of one member often join a jai started by another. In Korea today, you can still find jai groups that have been running continuously for half a century or longer, slowly funding houses, businesses, university tuitions, and weddings across generations. When Koreans immigrated to the United States in large numbers after the 1965 Hart-Celler Act, they brought the GYE with them. The Korean-American small business surge of the 1970s and the 1980s, including dry cleaning, corner stores, produce markets, and wig shops, was partially funded through these informal groups. Banks would not lend to a new Korean immigrant with no credit history. The GI did not ask for credit history. It asked who your family was, who would vouch for you, and whether you would show up at the dinner every month with your envelope of cash. To be precise, GAE was one channel among several. Korean ethnic banks like Hanmi began appearing in the 1980s. Family savings brought from Korea funded many businesses, and church networks also played a role. But GAE was the channel that worked when the others did not. The Japanese version is called tanomoshiko, sometimes also called mujin. It is documented from at least the 13th century in the Kamakura period, and it has the most interesting evolutionary arc of any system in this video. In Tokugawa Japan, mujin groups operated in nearly every village and town. A group of neighbors, trade associates, or relatives would pool monthly contributions, rotate the pot, and use it for everything from house repairs to merchant ventures. When Japanese immigrants came to Hawaii and the American West Coast from the late 19th century onward, they brought tanomoshiko with them. It funded farms in Hawaii, small businesses in Los Angeles, and fishing boats in Seattle, often when American banks would not. Here's what makes Japan different. In 1915, the Mujin industry law turned Mujin operations into licensed mutual savings banks. A number of Japan's modern regional banks trace their origins directly to that conversion. So Japan's rotating credit tradition didn't just survive into modernity. It became the foundation of part of the formal banking system. That is the only one of these traditions where the informal version successfully institutionalized itself into actual banks. The Filipino version is called paluwagan, and it works almost exactly the same way as a hui or a gaye, with one cultural twist worth understanding. Paluwagan groups are often built inside workplaces. Coworkers at a factory or an office contribute a portion of every paycheck, and one member receives the pot each pay cycle. Many Filipino domestic workers and overseas Filipino workers, who collectively send roughly $40 billion in remittances home every year, use paluwagan as a savings and lending tool while working abroad. The bulk of that remittance volume flows through formal channels, banks, Western Union, and dedicated remittance corridors. But paluwagan often handles the saving, the lending, and the pooling that happens around those flows. It is how a Filipino nurse in Dubai might assemble her brother's small business stake in Manila, or her own house deposit, without paying significant fees to any institution. The Vietnamese version, called HUI, and also known as Ho, Phuong, or Bieu, depending on the region, was a major piece of one of the most remarkable immigrant economic stories of the last 50 years. When Vietnamese refugees arrived in the United States after 1975 with almost nothing, HUI became a way to pool capital fast. A group of refugees who had escaped together would form a HUI, contribute small amounts week by week, and rotate the pot to whoever needed startup capital. The Vietnamese nail salon story is one of the clearest examples of what this can do, and it is worth telling honestly because the honest version is the more interesting story. In 1975, the actress Tippi Hedren, best known for Hitchcock's The Birds, was working as an international relief coordinator at Hope Village, a Vietnamese refugee camp in Northern California. The women there admired her manicured nails. She flew in her personal manicurist, Dusty Coots, to teach a group of 20 refugee women the trade. Those 20 women and the network they trained seeded what is today an industry where more than half of all nail salons in the United States and roughly 80% of nail salons in California are Vietnamese owned. Hui didn't start that industry. Tippi Hedren and those 20 women did. But Hui was a major reason the industry scaled so fast. Once one Vietnamese family opened a salon, a Hui could fund the second one. The profits of the second funded the third, often with another Hui smoothing the cash flow. Across a generation, that capital pooling mechanism let an entire community scale into a single industry, without ever needing a bank loan. A note of honesty here. Vietnamese has a specific word for Hui fraud, giat Hui, because it happens often enough to need a name. Theft by organizers and member defaults do occur. These systems have lower failure rates than payday lending, but they are not risk-free. Quick pause. If this is the kind of explanation you actually want from a finance channel and are not getting from other channels, hit subscribe right now. This is the kind of detailed cross-cultural breakdown that gets buried in academic papers and never reaches the people who could actually use it. More videos like this are coming. Subscribe so they reach you when they drop. Now to South Asia. The chit fund, called Committee or Committee in Pakistan and Bangladesh, and VC, Kuri, or Chitti in different parts of India, is the same basic mechanism with one important formalization. Many chit funds operate at much larger scale than a Hui or a Gai, with hundreds of members and pots running into the equivalent of tens of thousands of dollars. In India, chit funds got large enough that they became regulated by the government in the 20th century, culminating in the Chit Funds Act of 1982. Some are now registered companies. Some operate as cooperative societies. Some still run informally inside villages, neighborhoods, and extended families. The Shriram Group, today a financial services conglomerate with assets of roughly $38 billion, was founded in 1974 in Chennai as Shriram Cheats and grew from a chit fund operation into a major non-banking financial company. That trajectory, informal pooled credit becoming a formal non-banking financial company, is one of the clearest examples of how serious the chit fund tradition is as a piece of financial infrastructure. The South Asian version also developed a unique twist. In many chit funds, the order of who receives the pot is determined by auction. Members bid on the pot, with the lowest bidder winning. The discount the winner accepts becomes additional return for the other members. This essentially formalizes an interest rate mechanism inside the group while keeping the entire system community bounded. Two cautions are worth flagging here. First, chit funds in India have produced some of the largest financial scams in the country's history. The Sarada collapse in 2013 wiped out roughly $4 billion from around 1.7 million depositors. Second, the chit fund universe is bimodal. There are regulated, registered operators on one side and informal village-level groups on the other. The risk profiles are very different. When chit funds work, they are remarkable. When they fail big. So here's the question. 6 cultures, separated by oceans and centuries, developed similar private financial systems that bypass formal institutions. Why? The answer is the same in every case. Formal banks did not reach these communities, or did not want to serve them, or charge so much that communities had to build their own alternative. In ancient China, in medieval Korea and Japan, in colonial Southeast Asia, in pre-modern South Asia, the people who needed credit the most were exactly the people the banks ignored. So they built their own. And here's the part most outsiders miss. These systems were not workarounds. They were not second best. In many cases, they outperformed the banks that eventually arrived. They moved money faster. They charged less. They had lower default rates than formal microfinance. They served customers banks did not want. And they did it with almost no overhead, no buildings, no advertising, and no salaries. The reason so many cultures converged on similar mechanisms is that the underlying problem is universal. Wherever you have a community of people who know each other, who interact repeatedly, and who care about reputation inside that community, you can build a private financial system that competes with formal banks on speed and cost. The Hui, Gie, Tanomoshiko, Paluwagan, the Vietnamese Hui, and chit funds are all expressions of the same insight. Trust is the most expensive thing in finance. If you have it, you do not need almost anything else. A quick mention worth making here. There is a 7th system across the South Asian, Middle Eastern, and East African worlds called Hawala. It is not a rotating credit association. It is a parallel money transfer system where brokers in different cities settle obligations on trust, often moving billions of dollars a year faster and cheaper than any formal remittance service. It runs on the same underlying logic. Trust is financial infrastructure, but the mechanics are different enough that it deserves its own video. That is coming. So what can you actually take from all of this if you are sitting outside any of these cultures? 3 things, with caveats. First, the formal financial system is not the only financial system, and in many cases it is not even the best one available. There are people in your life right now who trust you, and who could be part of a small credit or savings circle. 3 people pooling a few $100s each month is mechanically the same as a Huey. It just is not called one. The technology of trust scales down to the smallest groups. The caveat: these systems work in high trust, repeat interaction communities. They scale poorly in environments where people change jobs and cities and friend groups every 2 years. The precondition matters more than the mechanism. If you do not have the community, you cannot build the bank. Second, the longer you stay inside a community where trust is real, the cheaper your life becomes. Banks exist to bridge trust gaps. The deeper the trust around you, the fewer of those gaps you have to pay to bridge. This is why every Asian wealth tradition emphasizes staying connected to the community, even when individuals get rich. The community is the asset. The cash is just one of its outputs. Third, and this is the one that matters most, the reason these systems lasted is that they made debt and savings flow through relationships instead of through institutions. When you owe a bank, you owe a building. When you owe a Huey, you owe 10 people who will see you at dinner next month. That second kind of obligation is harder to ignore. It produces better behavior, lower default rates, and stronger financial outcomes than any contract ever has. The honest version of that lesson has a flip side worth saying out loud. Trust-based finance is faster, cheaper, and more humane when the community is healthy. It's also more punishing when it fails, because the same social pressure that drives repayment also makes it harder to safely walk away when life genuinely goes wrong. The formal banking system is slower and more expensive, but it lets you exit. Both have their place. The cultures in this video built the first kind into the bones of their economic life, and it still works for them in 2026. 6 cultures, 6 names, 1 idea built into the heart of communities that the formal banks ignored. Built before modern banking even existed, and in many parts of the world still quietly outperforming it today. The next time someone tells you that the only way to handle money is through a bank, a credit card, or a payday lender, remember that hundreds of millions of people across Asia have been quietly proving them wrong for 1,000 years. Thanks so much for watching all the way to the end. The next video on your screen goes even deeper into one of these systems and shows you exactly how it shaped a specific immigrant industry from nothing. Click it, keep learning, and I will see you in the next one.